When it comes to GovCon M&A experience, today's guest is truly one of the best in the business. Kate Troendle, Managing Director at KippsDeSanto Co, has spent her career advising government technology and aerospace and defense companies through some of the market's most significant transactions. From investment banking roles at Stifel and Bluestone Capital Partners to leading deals at KippsDeSanto, Kate brings an insider's perspective on where the GovCon M&A market is headed and what makes deals successful. This is GovCon M&A Talk, presented by Orange Slices. I'm Sharon Heaton of sbLiftOff, and I live and breathe GovCon M&A. So let's talk deals. Hey, Troendle, welcome to GovCon M&A Talk.
Thank you for having me.
Well, we're talking about the GovCon M&A market. Certainly, it's been a very exciting and rapidly changing market. What is your perspective on what happened in 2025 and how that is affecting things in 2026?
Absolutely. It's a great question, and one that we spend a lot of time talking about. As you can imagine, the community is hyper-focused on what's driving M&A appetite for government contractors. And there's been a lot of trends over the last 18 months, both positive and negative, that have a material impact on the industry in a lot of different ways. I'd say over 2025, of course, we started the year with massive headline risks. I'll put risks in quotes because it was sort of unknown impacts. So the risk, particularly to buyers, was what will the current administration's priorities, primarily around DOGE, tariffs, spending, have on the GovCon community, what the impacts will be. As a result, buyers took a massive pause and said, we don't want to necessarily invest dollars into the space until there's a little bit more clarity. For M&A, the biggest risk is uncertainty. And so particularly DOGE and tariffs, among some lesser trends, caused a heightened sensitivity around uncertainty, which caused a lot of buyers to take a massive pause. That, of course, was talked about the most. As DOGE started to execute its mission, the clarity started to resume, the uncertainty started to dissipate. Of course, there was many companies that were very materially, and some that were only modestly impacted by DOGE. Some companies lost 90% of their work, 100%, 50%. I think the average was closer to the 5 or 10% of revenue was impacted to the community. So most companies were able to execute through DOGE. Tariffs had a much lesser impact on the GovCon technology and services space. So back probably around June, July of last summer, when some of that clarity resumed, we saw buyer appetite materially come back. And it was almost a massive pivot to buyers being 95% on the sidelines to all of them wanting to roar back into the sector. Last summer, there was a lot of talks of a $1.5 trillion DOGE budget. There was talks around additional defense spending. Defense tech started to take a boom. So you saw a lot of people wanting to invest in the sector. Some were a little bit more slower than others to come back, but certainly by the fall kind of time frame, there was definitely an increase in M&A activity. However, and this I think is talked about a lot less, and probably the biggest impact to 2025 in the GovCon space was the award activity. Combined with an already broken procurement system, when you saw before the current administration took place, you saw issues with CIO SP4, T4, a lot of the large IDIQs, a lot of protest activity being increasing even above what it was at prior to 2025. Throw in what the current administration did around cutting a lot of internal support staff within the government, a lot of which was around procurement and acquisition activity. You really haven't seen that award activity take place over the last, call it, 18 months. And that has had an absolutely critical impact to the community, because it's very difficult for sellers to be well positioned if they're not growing organically. I'd argue that M&A is really driven and currently in the current climate, but always by growth, right? Buyers are buying businesses to augment growth. And so they're looking for businesses that are growing consistently year over year. And when award activity is not happening, it's very difficult to grow. And you're seeing that public companies average expected growth rates in the 0-ish% range, and privately held businesses, private equity held businesses as well, are all really struggling with that internal growth. And I think that's had a really big impact. So we're starting to see that come to fruition. So kind of going back to your question, Sharon, I know I've said a lot, I think it's a healthy M&A environment. We've actually seen multiples hold pre-current administration taking place. We're seeing volume hold, but it's I would argue that after 2025, what we're really seeing is very well positioned businesses do very well, but buyers being increasingly critical of businesses that maybe are going to market a little bit too early. They're really looking for that growth, that dominant position within the marketplace, IP, et cetera.
Okay. That was a fantastic answer. And I agree with like 99% of what it is you just said, but I want to break it down a little bit. First of all, I think you made one point that I really want to call out here, which was in 2025, when there was so much uncertainty as to what's going on. Uncertainty equals risk. Risk to buyers means either lower prices or them standing on the sidelines. And I think that we saw that in a macro way in 2025. But companies need to understand that risk exists on a micro level as well. Buyers are looking for risks in the seller's company. And when they see risk, that means lower price to the seller. So that risk premium, both whether it's at the macro level or at the micro level, sellers really need to be paying attention to. And we make a huge effort to try and say to sellers, think like the buyer. Would you buy your company? Well, what's going on here? Now, we try and go to buyers as well and say, think like the seller. But in this circumstance, understanding the risk profile at both the macro and the micro strikes me as incredibly important. And I thought you made that point brilliantly.
Thank you.
Next is, you said that volume seems to be holding. Our experience has been that, as you said, towards the end of last summer, early in the fall, all these buyers came out of nowhere. I was talking to probably 5 or 6 buyers to every seller I was talking to. Now, these buyers, in my view, were looking for something that was a little unrealistic. They were looking for GovCon companies that were all full and open, that had 5 years of backlog, that had 25% margins, and preferably had a unicorn in the backyard. So I found that there were a huge amount of buyers, but I wasn't sure that the buyers were being very realistic about what the market was going to hold. Similarly, there were sellers who were pulling back, but also wondering whether or not buyers would be interested in them. And the feeling that I had, I'd like to get your take on this, is that really well-positioned sellers have a zillion suitors. They're the pretty girl at the prom. But that there's a lot of people who are kind of wallflowers at this point, and it's better not to go to market than to go to market and be a wallflower. What do you think?
Yeah, I mean, I completely agree. And I sort of alluded to that in a couple ways, around it being a little bit of a seller's market. But I think you're absolutely right. And I've used that term. It's a seller's market. I'll use those quotes again because it's a seller's market if you're well positioned. It feels as though, and partly I would argue because of that lackluster organic growth, right? Buyers themselves are experiencing lackluster organic growth. And if you're public and you need to justify a stock price, or you want to increase your stock price, and we know the public guys in the government services and tech space have been beaten up over the last 18 months, you need to augment that organic growth. We're seeing a lot of private equity assets that maybe are in their 4th, 5th, 6th year looking to try to do an exit soon, but are experiencing lackluster growth and looking for M&A to give them that jump that they need to kind of go to market. So absolutely, you are seeing there be a heightened demand from the buyer community. And we've actually seen multiples expand to that exact point, right? In 23 and 24, the median kind of multiple for government services and tech. So I'm not talking about defense manufacturing, but government technology, software, and services businesses was in the kind of 9 range. It was about 10 and a half for businesses above 100 million in enterprise value. And then what we've seen is that expand by about a turn in 25 and 26. So today the average multiple is actually 10, with a 13 times for businesses over $100 million. And that is exactly to your point, Sharon. That is a premium because the buyer demand is so strong, but we are absolutely seeing that buyers, and I think I made this point a little bit earlier, are being almost increasingly critical, if you will, or selective in their buying appetite. And so if you aren't well positioned, if you do have a near-term recompete, if you aren't experiencing growth, it is a difficult time to transact.
Excellent point. You laid the groundwork in a way that I thought was fabulous, which is, hey, what was the impact of 2025? The impact of 2025 was standing on top of a sandcastle of a broken procurement system. Those were wonderful words because we've been seeing the so-called silver tsunami happening for government contracting officers for years now. So lots of experienced people left, and then with the fork in the road, a huge number of additional left. One of the consequences of that seemed to be a lot of customer intimacy going out the door. That is, we've all as M&A advisors been telling our clients, hey, listen, you really need to know your client. You need to have customer intimacy. And I found that a lot of potential sellers had that, but then lost it with people who retired. Did you see that? And what did you advise people to do under those circumstances?
I mean, absolutely. I think a lot of businesses are struggling with the turnover within the government. And I think that there was already a massive movement and trend towards developing a solution orientation to your business, whether it's IP or not being that term everyone hates, butts in seats, right? But being differentiated. And I think when you do lack that customer intimacy, that it becomes even more important that you're delivering something that's above just a service, that you're providing a solution, you're sticky with your customers, you're embedded in all these buzzwords that the GovCon space likes to throw around, as well as non-FAR-based acquisition avenues. I'm sure we'll probably talk about that a little bit more. Maybe I'm teeing it up a little early, but around OTAs or SBIRs or an ability to get sole source contracting or using commercial type vehicles to get to the customers. And even more recently with the executive order around fixed price contracting, you're seeing the current administration have a much larger appetite for kind of commercial-esque contracting, and wanting to really be procuring solutions or IP. So I think that movement that was already in place pre the current administration is getting exacerbated or heightened, under today's climate.
The non-FAR vehicles are extremely important, and we all know that there's a move towards commercial-based solutions, OTAs, et cetera. Explain that to me a little bit. In order to be a government contractor, you need to have ISO certifications. Soon you're going to need to have now you need to have CMMC. You need to have all sorts of pricing restrictions, accounting systems. Do commercial firms want to sell to the government knowing that they need to come under those kind of regulations? Or are they looking to stay what they've been doing, which is commercial firms selling to GovCon and then the GovCon selling to the government? The government doesn't like the markup that occurs in that. But are we seeing commercial firms willing to walk into CMMC and OCIs and similar types of restrictions?
I think both. Certainly some of the commercial software vendors that have very significant, I don't want to necessarily name names, but significant traction in selling their products into the government space have been less excited or more reluctant to create an implementation practice within their firms and highly leverage GovCons to do the services work around those products, right? Whether it's, SharePoint or ServiceNow, Salesforce, all of that you're seeing those implementations. But we are seeing I don't necessarily know if it's heightened, but a consistent desire from more commercial services businesses or commercial product businesses that already have commercial services arms want to play in the government market. And so whether it's via an acquisition or penetration, but I think you raise a very interesting point, and we see this a lot, and a lot of small companies talk to us about this, particularly those that have a commercial branch and a government branch, is what happens to me if I go to market and I'm 50-50 government commercial, right? And I think you are probably limiting your buyer universe and trying to find those that are open to servicing both. But there certainly are, right? You're seeing Amazon come in a big way. So you're seeing some of these more traditional commercial folks want to be in the market, but it does take a different cultural lens. And it definitely takes a commitment and investment to creating a division that is more government focused for all the reasons you just mentioned, and not even just systems and scrutiny and security measures that you need to go through, but also just the sales model, right? The culture, the people, the management team. So I think it's a mix, but I still think it's probably more segregated than it is conjoined from, commercial folks wanting the government space, but we have continued to see that movement occur. I don't know if you would agree with that as well.
I was talking to a business owner recently who basically had a $25 to $30 million revenue company, services in Fed GovCon. And they said, we would like to get into commercial, so we're thinking about putting our resources there. And I said to them, hey, listen, are you so comfortable with where you are in GovCon that you feel like you can start an entirely new company with a different accounting system, a different marketing system, a different way of getting business, et cetera, so that you can, you're ready to run two companies under your umbrella? And they said, no, we didn't think that that's what we'd be doing. And it's like, well, it kind of is. So you might need to think about, are you willing to spend those resources? You're nodding your head, so you seem to agree with what I said.
100%.
Dealing with these GovCon people who are saying, well, there's some problems here. Let me go into commercial. I just think you're buying a different set of problems.
Right. And the smaller you are, the harder it is to do that. Right. I mean, when you're a multi-billion-dollar organization, you can create like a microclimate or a large division that does run differently, has different rates and different fringe pools and different this. But when you're 50, $100 million, it's very challenging.
Excellent. One of the things that we've mentioned a little bit back and forth is both services and products. And it feels to me like one of the trends that I'm seeing are people trying to take their services and productize them and be able to offer a product as opposed to a service. But when you scratch the surface, sometimes it still seems like a service. What are you seeing about services versus products, the government's interest in buying one versus the other, and what GovCon owners can do to meet that demand?
I think it's an excellent question, and it's a challenging one, and definitely an area that if a company is not hyper focused on that right now, they're behind the eight ball, I would argue, in the government space. Just like AI. If I meet a business owner that's like, yeah, we're not using AI, or same with us, right? Anybody, if you're not using AI, then you're behind the eight ball. Right? You've got to be looking at where the market's going, and the government has said they want to procure more solutions. They want to procure they want more differentiation. They want to move to that model. But the government is like a massive carrier. It doesn't turn quickly. And they say a lot of things, but they don't necessarily always do what they say. Just because they want to be a certain way doesn't mean that they are, right? A zebra can't change its stripes no matter how much they want to. So I think you have to read the room, and you need to be focusing, creating labs, R&D, creating IP focused on the solution orientation. Even if you never get to the point where you're 100% SaaS-based business, right? The government hasn't gotten there yet, but even if you're just creating IP that you're giving away for free, but that it's differentiating yourself or making you embedded with the customer, entrenched with the customer, I think you need to be doing. But, great case study on that is SilverEdge. We just sold SilverEdge to SAIC last year, and that was a fantastic case of a company that said exactly what you just said, Sharon. We are a services-based business, but we are creating software and we want to productize that solution. So they created a model, they call it SOAR, where it was effectively, I'll simplify it. The government has a need for a custom bespoke software solution. Instead of just going and building it and creating that IP for the government, they said, we'll build it on our own dime. It'll take us X number of days, and then we'll license that to you with the wraparound services. And the government loved it. I mean, it grew from, exponentially 0 to 50 million in revenue in less than 2 years. And I think that you're seeing the government say that they want to move more towards that model. The fixed price executive order that I mentioned earlier is another way of the government saying that they're looking to move more towards that. Do I think that's going to happen overnight? No. Do I think it's going to replace services? No. Do I think we're going to need butts in seats businesses? 100%. And I think that this transition is going to take a longer time than anybody believes. So I don't think that if you're a services-based business, you're going to be gone. But I think that you need to be thinking forward and leveraging AI and proprietary product development and forcing yourself into a position where you're differentiated from your peers.
You just said something that I've heard other business owners say to me as well, which is they're doing more, government contractors are doing more work on their own dime and then presenting the government with at least a minimum viable product, possibly even a finished solution, with the idea of saying we want to get embedded, a classic GovCon term, and then all the wraparound services, you need to come to us because we're the ones who did this. Is that a model that you're seeing kind of going forward?
Absolutely. I mean, I would say I'm seeing it tried more than succeeding. But we were working with a company last year that had created a ton of pilot programs, and none of them got picked up. Okay, great. But what it did, they actually won some other work that was separate. It showed that customer that this company, they were all around AI tools and that they were literally piloting, and they made a little bit of money, right? They got $500K here, $1 million there. So the government could test those pilot products. They didn't pick any of them up. But it showed and demonstrated how innovative this company was to that customer, because they got to be able to say, we've created these tools. So I think there's a benefit, even if you're not successful in your tool development. Another company I just spoke to said that they piloted a couple of years ago 5 products. They developed same thing on their own dime, 5 products to the government. The government picked up all 5, and they grew from 500K of revenue to 20 million of revenue, basically overnight. So, and it's the same thing with SBIRs, right? If you're not taking shots on goal, I mean, you're not going to grow. So I think that there's a lot of avenues to grow. You can try to make sure if you're small enough to get SBIRs phase 1s and 2s. Of course, you can go after competitive awards, but your P-wins going to be what it is. And then if you can do some IR&D and create some products, it's another avenue for you to get entrenched or get that penetration into new customers.
This is a real shift in government contracting. In the past, it's been the government turns to a company and says, here are all my requirements, give me a proposal, and this is what the company will charge in order to meet those proposals, and hopefully it will or will not over time. Now it seems like you got to put some skin in the game. You've got to seriously produce something for the government to then say, yes, we want it, no, we don't. It's more like a commercial business. If I build it, will they come? But you try and do it at the lowest cost so that you can figure out whether or not this is something the market wants. Am I correct in thinking this is a very significant shift in how GovCon owners need to be thinking?
I mean, I think it's all of the above, right? I think there's still a lot of that procurement, right? Just like, Alliant 3. Plenty of small companies went after Alliant 3, right? That is not necessarily developing your own IP, but it was a big IDIQ. So I think there's just, an increased demand for differentiation from the government. And I think there's an increased appetite for some of these more novel ways to penetrate work. So it is a shift. I would agree with everything you said there, that it's a new avenue of growth that whether or not the P-wins are higher or lower, whether or not it works for every company, I do think that every boardroom, every C-suite, when you're thinking about, I always like to say to any government contractor, who do you want to be when you grow up? what's your goal, right? Is your goal to sell in X number of years at the highest price? Is your goal to create a lifestyle business and just keep clipping coupons and taking out X $100,000 or $1 million a year? What's your goal? I mean, and then, okay, let's figure out what your goals are. And then what do you want to be to achieve that? And I think, thinking about your 3 to 5 year plan, coming up with proprietary solutions or leaning into that innovation is definitely something that we're seeing, not just government customers being attracted to, and therefore, to your point, Sharon, that model helping to drive growth, but also what buyers are looking for. Silver Edge, which sold to SAIC, SAIC has been very open and public about why they bought that business, because it was very different to their organic business model. And they kind of, I don't want to put words in their mouth, but effectively said, we believe the government model is shifting and we want to be at the head of that curve. We don't want to be left behind. And we believe Silver Edge is an industry leader within that shift. And we want to take advantage of that and augment, that solution orientation business. So I absolutely think that it is a shift, but it's probably slower than, some people want to claim that it's going to be.
You've used the same word multiple times, and I'm hearing it almost repeatedly now, which is differentiation. The companies that have some level of differentiation are where the value is going to lie. And if you are in more of an undifferentiated commodity sort, butts and seats, whatever we want to call it, that's almost like we talk about a K economy. I feel like there's a K lifespan in the GovCon market. There are folks who are going to do very well if they can be that differentiation. But if they can't, they're kind of going into a different pool. Is that a fair assessment?
100%. I mean, absolutely. I mean, what are there, 10, 12,000 companies operating in the government space? How many sell a year? 100? How many are able to transition away from a set-aside program into full and open? 100 a year. How many people bid on all these contracts? How many won, some of these large IDIQs, some of them have hundreds, thousands different, winners on that. You have to be able to differentiate yourself. We just sold, One Tech to Interion, which is owned by Macquarie last year, and that was their entire growth strategy. How do we want to grow up, we want to look like this, and we want to create a tool within Space Force, and we need cybers. And so they very strategically acquire businesses that gave them the ability to create that. And they're a $200-300 million business that has cyber phase 3s. One of them's very large. They have a direct OTA. They have IP, and that was all around the differentiation. And in the last 18 months, they won 3 very material contracts and are growing north of 20% a year when most people are flat to down. And that was all about how do we differentiate ourselves within the market. And I think particularly when the government is not awarding contracts, the only way to grow is by demonstrating your merit to the government and your differentiation and making the government say, we need this solution, we need this company to help us.
You mentioned something before that I've heard mixed things about, which is the government's willingness to pay licensing fees or to buy essentially a SaaS product. On one hand, you gave a great example of somebody who built it. The government then paid a licensing fee and then the wraparound services. Fantastic for them. But I've also heard that the government is extremely hesitant to sign any kind of SaaS arrangement, feeling that they're going to lock themselves into an ongoing obligation. What are you seeing about the federal government's interest in SaaS products?
Yeah, I mean, you hit the nail on the head. And it kind of goes back to what I was saying about the, zebra not being able to change its stripes. I think it'll be interesting to see. This fixed price executive order, I think, is a real step in that evolution, whether it's SaaS or fixed price milestone. We'll see how it plays out. I think we'll see more of it. I do. But I do agree with you. I think it's complicated, it's hard, and it's going to be an internal shift. A lot of the individuals within the government have been there a long time, and a lot of them didn't know about cybers or OTAs. I mean, and that goes back to that differentiation or your IR&D. I mean, just having a cyber does not mean that you're going to grow organically. You have to go in and sell and go talk to your customers and market your cyber and your technology. It's a tool in your tool belt, because competing on these FAR-based contracts has a low P win. It's very expensive. It's very timely. It can take 3 to 4 years, and sometimes they don't go to fruition. So I think I'm not really answering your question directly. I think we've seen the government be slow to adopt that, but when somebody can make the case and market it, and that company I mentioned, Silver Edge, it didn't happen overnight. They had to go in, spend the time, set up the meetings, market it to their customers. They started with a $1 million pilot program. They crushed it. Then they got another $1 million. Then it was 10 or whatever the numbers were. But it's work, right? It's not easy. The money doesn't grow on trees anywhere, not in the government space, right? You've got to go in and create your differentiation, whether it's IP, CIBRs, SaaS-based models, and then you got to go market it and sell it.
As we lift off, we spend a lot of time in the 100 million and below market, which means that we deal a lot with folks who are in the set-aside world. One of the things that I've been saying to people for a couple of years now and standing on my desk and waving my arms is to say, please don't start off by talking about your company by telling me that you're a woman-owned SDVOSB, hub zone. I don't care. Tell me what you do and why should I, or more accurately, the government care? And then it's oh, by the way, are you seeing larger companies interested in companies that are set aside with capabilities that have some differentiation, or are they in the mode of saying, no, we're just not going to do a set aside company until such time as they're in the full and open market?
Former. I think that there's been a number of, and I'll pick on private equity just because I think that yeah, well, and I'm only doing that because I think a lot of the public companies have done enough M&A to sort of understand the flavors of small business or set aside revenue. Sometimes you see private equity that's never done a deal in the space come in and didn't really understand it and bought a 100% set aside business and couldn't transition it because overnight, the business is no longer eligible for set aside. And then you see the Sage Winds, the Arlingtons, the CM Equities, the long-standing veterans in the private equity space that have done a lot of deals, they couldn't be successful without buying businesses that had set aside. I mean, we focus, you mentioned you're kind of under 100 million, but our average transaction size is right around 100-ish, 100 plus million. And we're supporting clients from the 50-ish million of enterprise value range, even slightly smaller, all the way up to 500 a billion. And I would say that, I mean, even SevOneTech that I just mentioned that was 200-300 million of revenue, they still had legacy set aside, not much, a couple percentage points, but I would say most of our clients on the services side have some residual legacy set aside. So I think it's important to think about the flavor of the set aside, and I think kind of going back to what we're talking about this butts and seats model, some of that lower end work that's not differentiated, that's probably going to be moving more into the set aside realm. And so, if you're doing work that's not differentiated and your customer says when you graduate, it's going to stay small and your options are get a JV or sub to, your friend, that's not that exciting to a buyer. But if it's CIBR phase 1s or phase 2s that are transitioning to phase 3s, if it's small because that was the easiest way for the government to get to you, if it was a directed award or it was this, and you have that differentiation, then I think buyers can create. And back to your point about risk, at the micro level, they can de-risk some of those risk elements because set aside revenue is in its nature risky to a full and open large buyer who can't easily, readily convert that to full and open upon a recompete unless they have a strategy and can get kind of, get traction around that and belief that they'll be able to de-risk that and pull it into the full and open environment.
It feels like it also is a question of how do they believe in the differentiation of that set-aside company. If that company truly has a differentiated technology, then at a minimum, you can get all the future work that they already have. You may not be able to get new under those vehicles, but you can do a discounted cash flow for that and then provide some level of incentive for mutual growth by using that technology and using it in a full and open way. So it does strike me that there's a potential win-win there. And my understanding is that these set-aside companies really do have value if they have differentiation.
100%. And that is, and one other thing that I think is very important, and we see this a lot when we're talking to set-aside businesses, is have you spent any time on the full and open environment? I think if you see a business, even if there's some differentiation, but their portfolio is 100% prime set aside and their pipeline is 100% prime set aside, we kind of say, that's great. And you can sit there all day and tell me that you're differentiated. That's great. But you need to create a path for this buyer. You need to have, whether it's one or two full and opens, converted one or two set asides, create a pipeline. So you have a roadmap for the buyer to underwrite the strategy around that. And the biggest way to do that is to demonstrate that is by doing it. So maybe you're 80% set aside, but 20% full and open transitioning. And so you've demonstrated that you can either compete in the full and open space or transition your work to full and open. And you've done the work to create the pipeline, the growth story, so that all of a sudden, when you're no longer eligible for those set aside contracts, you aren't going to just go poof. You already at least have this pipeline of opportunities.
I say to business owners all the time, and I think that you'd probably agree with this, please start bidding on full and open well before you graduate. You're going to lose, but you're going to learn a lot in the debrief, and you'll be stronger on your second and your third. There is a huge difference between a company that is 100% set aside with 100% of their backlog being set aside and one that has 20% in the full and open. You have now proven something, and that is incredibly important. Going back to the issue of risk, if you are totally in the set aside market, you've not taken the risk of getting into full and open. If the buyer is going to buy you, you're going to get a lower price because the buyer is taking on that risk. So you really need to figure out, as a seller, you can allocate the risk of leaving the set-aside market to the buyer, but expect the buyer to not give you a haircut on your purchase price because of that risk.
Absolutely. I mean, I would say the most successful sales are the ones where, kind of going back to what I said about, who do you want to be when you grow up? Buyers buy with intention. They don't buy because money's burning a hole in their pocket. They buy for a specific reason, for a strategic reason. Sellers should think about selling with that level of intention and that strategy. So just like you said, Sharon, I couldn't agree more. Don't just run your business and one day say, I want to sell. You got to say, I want to do X, Y, and Z, my roadmap, my strategy. I'm on the 18-month, 3-year plan. And what does that look like? And not to toot our own horns, right? But talk to your free banker friend advisors, not informally. Take them out to lunch and say, how should I be thinking about this? What should I be doing now to lay the groundwork for 18, 24, 36 months out?
Fantastic. We're going to be ending soon, but I did have one final question. You mentioned that multiples were going up. My impression, when I was thinking about this in 2023 and 2024, I was not putting a major valuation differential on Fed Civ versus Defense, now DOW. I have to say, I don't think that that's true anymore. I really do think that the valuations have shifted, whether you say they've shifted on Fed Civ or they've shifted on defense, aerospace, IC. IC has always been a little different. What are you seeing in terms of valuation in comparison, Fed Civ to the Defense Department?
Yeah, it's a tough one. It's hard to take two identical businesses right now, one that's Fed Civ and one that's DOW, and do a multiple analysis. So I'm hesitant to say that there's a value gap. I think a well-positioned, growing, differentiated business operating in pockets of the Fed Civ space that are growing, that are high priority, could do just as well as a business operating the DOW. So it's hard to find two peers. But what is true, and probably why that valuation gap occurs, is because there's maybe some less well-positioned Fed Civ businesses selling. And so they're getting a discount because they haven't grown, they've been doged, they've X, Y, and Z, they're in pockets that aren't as exciting. And there's just more DOW interest from the buyer community, right? So buyers are more focused there. So there's more deals being done, right? So we actually are talking to a number of FedCiv businesses about trying to figure out the right time, but they're either waiting for pipeline opportunities to hit, they're waiting for this, but but they look well positioned. So they just haven't gone to market yet. I was just talking to a business in CMS. I mean, their business is growing rapidly and they're doing a bunch of really cool AI work. I think that business will do phenomenally well in the market. But it's hard because right now you're seeing a little bit more growth, a little bit more budgetary dollars flowing to the DOW space. So it's a little bit hard to find that apples to apples comparison from a valuation purely standpoint.
It is a terrific answer. Kate, I really want to thank you for coming on the podcast today. This has been a wonderful conversation, and I look forward to having many more with you.